This tutorial is about the financing decision. The financing decision is one of the primary responsibilities of a financial manager. The financing decision will be largely influenced by the target debt to equity ratio. In other words, the acceptable level of debt in relation to equity will inform whether the financial manager needs to look for debt or equity. At a high level, the financial manager needs to decide between whether they're obtaining their capital from debt or if they're obtaining their capital from equity. But there are different kinds of debt and there are different kinds of equity. If they decide to go for debt, then they can obtain a loan from a financing institution like a bank. Alternatively, if they're going to be purchasing an asset, then they can get a bond over that asset. Remember, a bond is basically a loan that has got collateral or that has got some sort of underlying asset that the credit provider can sell in the event that you default on that loan. Or the financial manager can obtain financing from the capital markets through the issue of debentures. If the financial manager decides to obtain financing via equity, then they would sell shares in the entity. They can either sell ordinary shares or they can sell preference shares. Ordinary shares are also known as common shares. The holders of these shares get to share in the profits after every other capital provider has been paid. Preference shareholders, on the other hand, have got a higher claim than ordinary shareholders. And when it comes time for payment of dividends, they are first in line to receive their dividend before a dividend gets paid out to the ordinary shareholders.